All right, welcome back. Today we have another stock analysis for you of a very recognizable brand, so I think you're going to enjoy this one. Have you ever heard the advice that if you use a product, that means you should buy shares of that company? For instance, if you have an iPhone, that means you should buy Apple. And if you own Jordans, you should own more shares of Nike than you have of Nike shoes or Jordans. That is horrible advice. I understand that sometimes when people are getting into investing, if they're investing in the things that they use, then that might get them interested and keep them going. However, that is a horrible strategy, because how do you know that you can afford the risk that that company has? How do you know that that company fits in your portfolio? So we always have to look at whether the business is a quality business before we do that. Just because you enjoy the product doesn't mean the business model is great, doesn't mean that they have a competitive advantage. It just means you like the product. So we're not going to invest that way. We're going to look at Nike today and look at how quality of the business this is. And at the end, we're going to take a look at the valuation and see, do we think this company is undervalued, given that they're facing some headways with some tariffs and also a recent change in the CEO. So we're going to take a look at Nike right now. Nike right now is trading at $76 per share. As we see over the past 5 years, they are on somewhat of a downtrend, not a sharp downtrend, but the stock has been coming down. So let's look at the results to see if the revenues and the cash flows of this business are declining along with the stock price. Right now, they are sitting at a $112 billion market cap, a beta of 1.2. I'm noticing a lot of these larger, more established companies are having high betas. We would like to see a company like this under 1. We want them to be less volatile than the rest of the market. PE ratio right now of 35, and they have a dividend yield of 2.25%. So let's dive right into it to see what we're looking at. All right, so Nike, the business segments. What are the segments that brings in the money for Nike? They are 69% footwear and 31% apparel. That's where they stand now. So of course, we would assume that they're more of a footwear brand, and that's the case based on their financial results, 69% footwear. Let's look at the revenues here. We have 30 billion in 2015, 51.3 billion in 2024. So strong trend, 1 year of negative growth, but this is a COVID year. So that's something we can kind of ignore. That makes sense. After that year, we see that they bounced back pretty strong from 39 to 44 billion there. Looking at the margins, 46 down to 43 and ending at 44. So pretty solid, consistent gross margin as we would expect from a business like this. So looking at the chart to give us a visual of what we just looked at. Of course, we had this one COVID year here in 2020. So we understand we're not really worried about that year, well, actually 21, and bounce back stronger and continue to grow. Looks like revenues are growing at a slightly faster pace than gross margins, which means they're able to bring in more money and push costs to the customer, but they're not growing in efficiency there. So still both solid trends, revenues growing a little bit more than margins, but overall pretty solid revenue and margin trends there. Let's look at the profit, see if we see the same thing. A little bit worse. We have 2 years of negative growth. Again, we're not really worried about COVID because we understand what happened there. Not a normalized environment, so we're not going to include that in the analysis. 3.2 billion to 5.7. So solid margins, 10%, and you got 11. So margins are pretty consistent. High of about 13% here, low of about 5.3 in 2018, but overall consistent. Let's look at the visual of this as we see. So we don't like these drops, but the thing is, when they bounce back pretty strong and well above the previous trend. So it kind of continues along that line. So we're seeing similar things here. We have some highs, a few dips here. It's coming back up. We'll see in 25 if that trend continues and is above that 6 billion mark there. If that's the case, then this company is consistent and growing and pretty much has a cycle when it comes to their profits. So let's look at the free cash flow. What is the money that's left over after they generate cash from operations from delivering their products to the customer and then taking care of their capital expenditures? The capital expenditures representing the required reinvestment back into the business. What's left over after that? 2015, we got 3.7 billion. 2024, all the way up to 6.6. We do have we ignore that, 2 years of negative growth. So that stock or that free cash flow dipped. But of course, as we saw with profit, as we saw with revenues, when it bounces back above the previous high. So not to worry about that. When you're talking about the market leader, the number one and highly competitive space as well, this is what you can expect. So free cash flow, again, ignoring 2020, since that was COVID, but we have 2 years of dips, then we come back pretty strong. 2 years of dips, come back pretty strong. So again, similar to the profit and revenues, we see this 2 to 3 year cycle where they'll have dips, but they'll come back and it's above the previous high. What we would expect, or we don't mind seeing this with this type of company in the stage that they're in. A mature company, this is an okay trend to see. Let's compare that free cash flow to debt. Of course, with the free cash flow, they're going to pay off debt. They're going to pay dividends, buy back shares, and do mergers and acquisitions with that free cash flow. Let's see what that looks like compared to debt. We want something below 3. If not, then definitely below 5. $1 billion of debt to $10.4 billion in 2024. And we see that only 1 year, that was that COVID year when they had low cash flow, is where we will see that the debt to free cash flow was above 5, that 8.8, but an anomaly, not a normalized environment like we mentioned before. Any other time, they're well below 3. Averaging for the past 3 years, 2.1 times free cash flow. That means, on average, they can pay off their debt in about 2 years with the free cash flow that they generate. So a pretty solid, great leverage position for them. We like to see that. So let's go to the dividend and see what we're talking about here. All right, so the payout ratio is 32.8. 32.8% of that free cash flow is being paid out to the shareholders as a dividend, which means they have some room to grow, room to run and continue to grow that dividend, about 2% yield there. But let's look at the years of growth. We have 8% growth, 8, 11, 10. If we continue down, we have 12, 11, 10, 11. So since 2018, they've pretty much been growing their dividend every year at about double-digit growth other than the last 2 years. So in 24 and 23, it dropped below double-digit, 8%. That 8% is still above the 5.7%, which is the average dividend growth rate of the S&P 500 companies. So well above average as far as the growth rate, still with a low payout ratio, which means they have room to grow. And we saw that their free cash flow is continuing to grow. So the pot of money that they have to pay out that dividend is growing as well. So solid dividend position, solid dividend policy for them. Now let's look at shares outstanding. This is something else that they can do with their free cash flow that also adds value to the shareholder. Buying back shares and decreasing that share count, which gives the existing shares more value. And we see that that's what they're doing. It did come up from 2020 to 22, but a very strong downtrend from 22 to 24. Love to see it. So shares are coming down, which means to the people holding it, their shares are becoming more and more valuable. So great trend there. Let's look at the value added. Let's look at how much money are they bringing in compared to the capital that they have to infuse into the business and earn that money. So we're going to look at the return on capital, and we're going to look at the cost of that capital. So return on capital for Nike, 18.49%. Cost is 5.6, creating a spread of 12.8. So over the past 5 years, they're averaging about almost a 13% growth in the economic value of the business by having this wide of a spread over the cost of capital. So that is how we manage, or how we evaluate the effectiveness of management. When we look at the cost of capital and compare it to the return on capital. So 12.8% is pretty solid for this business. Now let's look at the valuation. After we looked at all of that, what does that mean for the value of the company? And this is a great example because it can get a little tricky here. So they are estimated to grow about 6% annually for the next 5 years. This makes sense for a company that is at the top of the market, and with new players entering and becoming more popular, this does make sense. So I don't believe this is a fair estimate at 6%. So the discount rate, the hurdle rate that I'm going to use is the cost of capital, 5.6%. So I'm gonna leave it there. Terminal value, I expect if I were to buy the stock right now in 5 years, I should sell it for a multiple of about 27 times their current free cash flow amount. For reference, they have been trading at about 27 times free cash flow on average. So I'm assuming that I can get at least the average multiple or the average price to free cash flow there. Now, here's where this could get tricky. Right now, they are trading at 17 times free cash flow. So right now they're trading at about 10 times less than what they were, or 10 points less than what they typically trade at when it comes to their multiple and comparing that to their free cash flow, which means that one or two things. This company is undervalued at the moment, and this could be a good entry point, and we'll just kind of be patient and wait for it to rebound. Or the market is looking at Nike differently, and that 27 times free cash flow could be a little bit too high compared to how the market is going to look at it in the future. Remember, when we buy stocks, we're buying the future cash flows, and we benefit from how the market is going to view this company in the future compared to now. So is Nike going to kind of regain their reputation and turn things around and bounce back up? That's what I think they will, but we don't know. The market could kind of adjust and look at it differently, but assuming that we can get 27 times free cash flow, and assuming that this 17 times is just a representation of it being undervalued at the moment, I estimate that this stock is about $107 as far as its intrinsic value. So looking at about a 40% upside compared to the share price of $76. This gives me a fair value range of about 96 to 118. Yes, the calculation does give me an exact dollar amount. However, I'm more interested in the range of fair value. I'm not trying to be exact. I'm just trying to be directionally accurate. That's where I think the value of a discount cash flow comes in. So that's my thoughts on Nike. I do believe they can or will bounce back. Remember, they changed out their CEO. They went from this new guy that they hired, or this guy that they had in there that was changing Nike to more of a lifestyle brand instead of its roots, which is an athletic brand. So they kicked that guy out, brought in a CEO that used to be with the company before, totally understands the brand and the messaging of Nike and why they are who they are. So I believe over time, that's going to turn around. They do have some pressures when it comes to tariffs. So we'll see what happens with pricing and with the overall economy with demand. But these things, I believe, are more temporary when we're talking about long-term investing. So with that said, I believe we're going to be at around $107 for intrinsic value. So those are my thoughts on Nike. Let me know what you think in the comments. This analysis will be available on my Patreon, so check the link in the description and check that out if you're interested, along with all the ones that are coming in the future. And I'll start loading all the ones that I've done in the past as well, probably 2 to 3 per day. So look out for that. So hope to see you in the next video.